Hey there, this is Larry Hughes, broker associate with Elite One Mortgage, and welcome to today's mortgage update. And today's video, we're going to be talking about Fannie Mae and the most recent changes they've made in the last couple of months. So before I get started, however, for compliance reason, I must mention again, my name is Larry Hughes. It's my cell number, and my license number is 324686. That's my NMLS license number, and my Department of Real Estate license number for California is 01487068. So again, let's talk about Fannie Mae's recent changes to their loan program, most recently for loan limits. So Fannie Mae did something just recently. They say they noticed that home prices have continued to increase, and they've changed the loan limits for conforming and high balance loans. What does that mean to you? That means they increased it so that you can buy more for less. Interest rates are down, loan limits are higher, so right now you could buy more home for less amount of money. And let me tell you what I mean by that. Previously, there's something called conforming and they're called high balance. So if you were in from 0 to 484, you were in what's called the conforming loan limit, that you fit inside of a box that Fannie Mae used to price out your deals, or to be less risk, or the least amount of risk, from 0 to 484. So they changed that now. The conforming loan limit for a single family home is now went from 484 to 510. So if you were over 484, you went to the high balance, which increased the risk, which also increased the interest rate. But again, they changed it from 0 to 484 to now from 0 to 510, 400 for a single family residence. Conforming for a duplex or 2 units is now 653, 550. For a triplex, it's 789, 950, and for 4 unit is 981, 700. So again, that is for the conforming rates only, conforming loans only, conforming, CONFORMING. And then now we have the second tier for Fannie Mae and Freddie Mac, which is the high balance, or the high cost areas. So for the high cost areas such as Los Angeles, Orange County, and other places around the country, where the conforming stops, the high balance starts. So it went from 484 to all the way to 720 was the high balance. Now high balance maximum loan amount is 765. So 765 for those areas around the country, like Los Angeles, Orange County. I'm only really talking about LA and California. But around the country, there's also other high cost areas. That loan limit for high cost areas or high balance is now 765 for a single family. For a duplex is 980. For a triplex is 1,184,925. For a 4 unit, that loan limit is 1.472,550. So again, you have what's called conforming, which fits in the lower risk tier for Fannie Mae and Freddie Mac. And then you have high cost area or high balance areas and it starts from where the conforming ends, again, to the loan limit of the high cost areas, which you just mentioned here. So they increased it. So now you can buy more for less. That's the loan limit changes that Fannie Mae just implemented. Or actually, let me say something. They will be effective January 1st, 2020. Right? So everything I just mentioned is not right now. It's January 1st, 2020 for most lenders around the state. I happen to be a mortgage broker who work with a lender we're locking and closing these deals now, even though won't be effective for Fannie Mae and Freddie Mac until, again, January 1st of 2020. I work with a mortgage or a lender who's locking these loans and closing these loans now at the new high cost or in the new loan limits. The second change I want to mention in today's mortgage update is something they put out a little earlier in October, and they talked about buying units, right? So buying units, I printed out the guide. Buying units now is a little bit more difficult. In previous time, what would happen in an example of a 4-unit purchase, right? We've been talking, you've been hearing the term house hack, where you would buy a 4-unit property or a 3-unit property, but for this example, we're talking about a 4-unit property, you would have to occupy 1 unit, and then you have 3 other tenants for your units. For round number sake, let's just say the rents are $1,000. We would give you $750 each tenant, or 75% of the actual rents or market rents to add to your income. So for this example again, $750 times 3 will give you $2,250 to add additional qualifying income to help you qualify for that purchase, right? So that's what the rule was before with Fannie Mae and Freddie Mac. They came out in October with a mortgage announcement that effective December 10th, December 7th, this no longer applies. If you are a first-time home buyer, you used to be able to do this. Be easy to help you get in, right? You get $2,250 to add to your income to help you qualify for that 4-unit. If you're a first-time home buyer or a person who does not have the service or the experience of rental income evidenced by on your tax returns, then you can't do this. This does not apply to you. You must, the buyer or the borrower in Fannie Mae's case says, you must qualify on your own income. You can't use this. So this is a big game changer coming up here on December 7th, that if you don't have a rental experience or as a property manager or a rental experience on your evidence on your tax returns, then you can't use the income from the subject property for qualifying purposes. You must use your own income. That I want to leave my opinion out of it, but that is a big change in the way things are going. The second thing they did, however, is a good thing for people who do have that qualifying experience of rental income or property management, is that no longer are you limited to just 75% of the rental income. If you have, again, that property management experience or rental experience evidenced by your tax return, you can use the full $1,000 to help for qualifying purposes. So you're getting an extra $750. So $3,000 actually will go, instead of the $2,250, will go towards your income to help you qualify to purchase this. There's some other odds and ends to this announcement here, but that is what I wanted to get across today in today's mortgage update. The term house hacking has been used for a little while now, and it's getting a little bit complicated. All right, so this is Fannie Mae and Freddie Mac. FHA still allows this. You don't have to have rental management or experience of a rental. FHA still allows this. However, in years past, if you've been following the mortgage market, we know that FHA follows behind Fannie Mae and Freddie Mac. It may take them some months, 8, 9, even a year, but in recent past, everything that Fannie Mae and Freddie Mac has done, FHA has adopted. Like this 75%, this has always been Fannie Mae and Freddie Mac, but FHA used to allow 85% of the qualifying, 85% of the rents for qualifying income, but they followed in the steps of Fannie Mae and Freddie Mac, and took it back down to 75%. So this is following years of experience. So the point I want to get across here in this mortgage update is that things are changing. If you are on the fence about buying, or you're trying to wait till some significant event happen, I suggest that you reevaluate and see if this affects you. If you plan to buy units or something like that, and you are waiting for some significant event, or like the market to turn or anything, I think you need to take a look at this and maybe to speed up your timeline. This is a significant change in the market, and as things tighten up, it's going to be a little bit more difficult to purchase 4 units the way we are customary in purchasing them. So it's not that it can't be done, but it's a little bit more complicated now as of December 7th for the conventional side of purchasing. FHA, again, still allows this. So if you require any additional information, I'm Larry Hughes. I'm a real estate and mortgage broker, licensed here in California, do business all over California. You can give me a call directly at 323-228-2736. Again, that number is 323-228-2736. I'll put it here, and there again are my license numbers. And again, I'm Larry Hughes, and thanks for joining me for this mortgage update.